Good afternoon. My name is Stephen Herwire. I am the owner and founder of Herwire Financial Plans with Direction. Today is September 30th of 2022. After the market roundup, we're going to talk about market turbulence and, more importantly, what to do about it. Few important disclosures up front. The opinions voiced in this material are for general information only, and they're not intended to provide specific advice or recommendations for any individual. All performance reference is historical and not a guarantee of future results. All data is believed to be from reliable sources. However, no representation is made as to its completeness or accuracy. None of this is to be construed as tax or legal advice. I am not qualified in that area. Consult your advisor prior to taking any action. And when you see the slides with really nice graphics, they are from JP Morgan's Guide to the Markets and Guide to Retirement. Recent numbers as of last night, the Dow Jones Industrial Average closed at 29,225.61. Year to date, it is down over 19.5%. The S&P 500 closed at 3640.47, down 23.62%. The NASDAQ 100 closed at 11,164.78. Year to date, it's down over 31.5%. Gold closed at $1,661.01 per ounce. Year to date, it's down 9.19%. The Bitcoin index is down is at 19,470.5. It is down 59.35% year to date. US dollar index, it is at 112.57. Year to date, it is up 17.66%. The 10-year Treasury is at 3.7%. It is up from 1.51%. The S&P aggregate bond index is 192.45, down 13.24%. The sky is falling. Sky is falling. Or is it? As numbers indicate, this has not been a good year if you're invested in the stock market. Of course, it's not been good many other places. And for anybody who's filled up their gas tank or bought groceries, know that in spite of the FDIC or equivalent insurance on your bank account, your purchasing power is also down. So in the short term, the answer is to budget carefully and shop for deals on things you need. This is always a good policy, but it's never been more obvious, or at least it hasn't in a long time, than now. The long-term answer is to not base your investment decisions based on current events, but stick to your plan. And if you don't have a plan, get one. I may be able to help with that. I'll talk about that later in the broadcast. Okay, here we have a great chart that talks about returns on the S&P 500. Now, if you would put $10,000 on January 1, 2002 into the S&P 500 and sat on it until the end of last year, you would have walked away with $61,685, up 9.52% on average. But because we're in one of those extreme market declines, there's a natural emotional reaction to take control by selling out of the market and seeking safety in cash. This is due to something known as loss aversion, or the fact that losses hurt more than gains feel good. The results of this action can be devastating because during periods of market volatility, the best days are likely to occur close to the worst days. So if you bail out hoping to get back in at just the right time, which I don't even know how you determine that, it might be a mistake, because if during that 20 years that same investor had just missed out on the 10 best days, instead of walking away with over $61,000, he would have walked away with just a little bit over $28,000, or an average return of about 5.33%. Now, if he'd skipped out for 20 of the best days, then that $10,000 would have turned into $16,804 for missing out on the 20 best days. Now, if he'd missed out on 30 of the best days, he would have still made money, but it wouldn't have been much. He would have had a profit of about $904. And if he missed out on 40, that's when you start losing money. Now, the only way to make sure you're in for all the best days is to make sure you're in for all of the days. There's no way to predict when those good days are going to be. Staying the course with a diversified long-term investment strategy may produce a better retirement outcome. This is one of my favorite charts from JP Morgan. They call it the measles chart. And for anybody who can see all these red dots, you can understand why it might be called the measles chart. Now, this is a chart of S&P 500 returns going back to 1980. All the red dots are the lowest spot in the year for the index. Now, anybody who's been investing as long as I have well remembers Black Monday in 1987. The stock market fell 20% in a single day. It was not a good feeling. But had someone put their money in the S&P 500 at the beginning of 1987 and sat on their hands and did nothing during all that turbulence, they would have walked away with about a 2% gain. That's what the gray bars indicate. They are where the stock market ended up. Now, if you notice, you'll notice more of those are up than are down. I did a hand count before I saw JP Morgan was kind enough to say, count for me, because they say at the top, 32 of those 42 years, the annual returns were in the positive, and there was the average of the drops is about 14%. So moving on. Now, generally speaking, you have no idea where something's going to go in the next year. I don't know. You don't know. Everybody's crystal ball works about the same, which is to say not at all. But if you look at history, going back to 1950, this chart shows returns of the S&P 500, a bond index, and a 50-50 mix. The green bars are the S&P 500. The blue bars are the bond index. And the gray bars are for somebody that decided to put their money half and half. So going back to the 50s, the rate of return on the S&P 500 ranges anywhere from minus 39% to plus 47%. So if you're putting that down payment for your house or your emergency fund in the stock market, something that's going to be expected to be spent in the next 2 years, couple or 3 years, you are gambling, and I do not recommend it. So for things like that, things you know you're going to need in the short term, I would recommend something liquid, preferably something that has some sort of FDIC insurance or the equivalent on it. Because I know where that stuff's going to be in a year or two. The stock market, I don't have a clue. The bond market's even a little bit on the risky side too, because you see that there was at least 1 year where the bond market fell 8%. And but at the other end of the scale, it was up 43% and all points in between. And if you split it 50-50, your worst 1 year performance going back to 1950 was 15% down. Best was 33% up. Now I'm going to skip ahead to the 20-year rolling average. These are the best in, any 20-year period going back to 1950. Now, why is a 20-year period important? Well, a couple that is age 62 and not a smoker has a life expectancy, a joint life expectancy of 92. So one of them will probably live to age 92 for 30 years. Probably both of them will live at least 20. You never know. So in any case, your worst 20-year performance being in the S&P or the stock market is 6%. Your best was 17. Now, if you decided to be conservative and just stay in bonds, your worst 20-year period was 1%. And that doesn't even keep up with the inflation that we had before the inflation we're seeing in the last year. Its best performance was 12%. If you split it 50-50, 5% was your worst 20-year return, and 14% was your best. This is why it's important to have a diversified portfolio. Okay, let's talk about inflation. Again, everybody has this impulse, sell out and go to something safe. So one of the safer things you can put your money in is a 6-month CD. Usually it has some sort of FDIC or other insurance on it. So let's look at how these did. In the 1980s, your average 6-month CD ran about 10%. Now it lists a lot of headline numbers here, or a lot of inflation numbers here. The headline number is the bright blue one. That's the one you see on the news. In the 80s, the average headline inflation was about 5.5%. Housing inflation was higher, medical inflation was higher, education inflation was higher. But in the 80s, you could get a 6-month CD that would keep up with that, at least in most cases. Now, when we wandered into the 1990s, when interest rates started going down, your average CD was giving about 5.4%. Still more than enough to take care of headline inflation and housing inflation, just barely enough to keep up with medical inflation, but education inflation couldn't keep up. Then when we moved into the first decade of the millennium, you could only get about on average 3.3%, which would keep up with headline inflation and it would keep up with housing inflation, but it wouldn't keep up with medical or education inflation. 2010s, CDs were even worse. Your average CD would get about 0.5% over the decade. Wouldn't keep up with any of the numbers. And 0.3% in the 2020s so far, granted, we are only about 2.5 years in. 0.3% doesn't keep up with any of the inflations. And right now, the average headline inflation is 5.2%. And you're going to say, Steve, well, you just told us, 8% was the inflation. That's what we're hearing on the news. Well, it doesn't count for the fact that in 2020 and parts of 2021, inflation was really low. So if you've got all your money for the long term in so-called safe things like 6-month CDs, just got one question to ask you. Are you comfortable going broke slowly? Long-term planning. A few things you should know. First of all, no one can predict the economy. And as such, the market cannot be reliably timed. The long-term solution is to have a financial plan and to work that plan and ignore the day-to-day gyrations of the market. Now, I'm going to give you a Herwire original saying, nobody tunes into the Weather Channel to see a sunny day. This doesn't happen. They're looking to see hurricanes, they're looking to see storms, not a sunny day. Similarly, and this isn't mine, in the news business, there's a saying, if it bleeds, it leads. So all the negative information is going to be in the news. And since we can't predict the market or time the market, we might as well ignore it. And I watched a broadcast earlier in the month by one of my favorites. His name's Nick Murray, and he said a couple of things that I wrote down. They were so profound. All lasting investment success is plan-driven and goal-focused. All investing failure is market-focused and events-driven. So you got 3 phases of life you're going to go through, and this is where you need plans. Okay, so when you're in the work phase of your life, you need a plan that does 2 things. It helps you determine how much you need to save in order to retire in a time and manner of your choosing, and to make sure you're allocated in a reasonable fashion. Then, I paint the picture that this is like getting ready for an ocean voyage. During your work life, you're building your ship. Okay, when you're in the home stretch, the last 5 to 10 years before retirement, you're loading all the food and the other stores on the ship, and you're making sure your ship is ship-shape, ready to sail when you want it to. You need a plan then to determine when exactly you can set sail, or in this case, retire in the manner of your choosing. When you're in retirement, you need a plan to spend your money in such a way as that you don't run out of money before you run out of life. Because when you retire, you're going to go through one of 2 doors. Door number one is where you run out of money before you run out of life. This is the default door. If you do nothing, this is where you're likely to end up. Door number two is where your money outlives you. The problem is you don't make this decision which door to go through at retirement. You make it all through your working life. So you're making this choice every day without even realizing it. As I mentioned, you've got 3 stages of life. You've got the working stages, which when you graduate from whatever school you're going to go into your chosen profession, this is the critical time you need to save for retirement. And the sooner you find out the answer to, am I saving enough for retirement, the less a pain in your wallet it's going to be. And the plan in this instance answers the 2 questions. Am I saving enough, and is it in the right place? Once you get to retirement, the question it answers is, how do I avoid running out of money before I run out of life? And then there's the legacy. It's what some have called post-retirement. Does what I worked hard for get to where I wanted it to after I am done with retirement? All these things, you can have a measure of control, but it requires planning and help from somebody like me. Okay, if you have questions, if you'd like to schedule an appointment, you can go to my webpage, herwirefinancial.com. There's a big schedule an appointment button in the upper right-hand corner of every page of my website. Now, if you want to see this video and others like it, as they get approved, you can click the YouTube button, 2 buttons over from the schedule appointment button, and see things like this. Please follow me on Facebook, LinkedIn, and Twitter, and YouTube. And if you have friends that you think might be able to benefit from hearing some of this information, please recommend me. And for those who prefer the good old-fashioned telephone, my phone number is 518-631-2569. Have a nice day.